Welcome, learners, to the deep dive. Today, we're taking a shortcut to becoming exceptionally well-informed on a topic that touches nearly everyone: income tax assessment procedures. Get ready for some serious clarity, fascinating insights, and maybe even a few surprising facts to keep you hooked.
That's the plan. We're aiming for real understanding here.
We've been given a comprehensive set of sources, a detailed document outlining the intricacies of assessment procedures under the Income Tax Act 1961, and some incredibly insightful audio commentary. Our mission
Cool. Yeah.
is to distill every essential concept and detail from these sources. Think of it as creating an exam-oriented summary that's not just thorough but also deeply understandable, equipping you for even the trickiest application-based questions. We're going to ensure you grasp not just what the rules are, but why they exist and, what they truly mean for you.
Indeed, our goal is to help you transcend mere memorization. We want you to truly comprehend and apply these complex provisions. We'll be connecting the dots, exploring the why behind the rules, and equipping you with the nuance needed to master this subject, whether you're facing an exam or just trying to navigate your own tax landscape.
So whether you're prepping for an exam, trying to demystify your own tax obligations, or just have an insatiable curiosity about how it all works, stay with us.
Okay, let's unpack this. We're diving straight into the very cornerstone of the assessment process, the return of income. Think of it like the opening move in a grand chess game between you, the taxpayer, and the tax authorities. That's a great analogy. At its core, the return of income, often just called an ROI, isn't simply a form you fill out. It's your formal, prescribed declaration to the government about your total income and the tax you believe you're liable to pay for a given financial year.
Right, the official statement.
Exactly. The Central Board of Direct Taxes, or CBDT, meticulously prescribes these formats. They're quite detailed, requiring you to break down your income under various heads, calculate your gross total income, account for any deductions, and finally, state your net tax payable. It's your official, comprehensive financial statement for the year, delivered straight to the tax department.
It sounds like laying all your cards on the table. This declaration, as you say, is absolutely crucial. It's the starting point for the tax authority to understand and then, crucially, to verify your or your entity's tax position. Without this initial self-declaration, they wouldn't even know where to begin their assessment process. It's the first step in that intricate dance of assessment we talked about.
Building on that foundation, let's look at who must file a return. For certain entities, like companies and firms, it's a non-negotiable requirement.
Non-negotiable.
Yes. They are mandated to file a return of income or even a loss for every previous year by a specified due date, regardless of whether they've made a profit or incurred a loss. This ensures constant financial oversight for these business structures.
That makes sense for businesses. But what about individuals? Many people assume if their income is below the basic exemption limit, they're, off the hook. But that's not always true, is it? It seems the net has widened considerably.
It really has.
You mentioned other persons, specifically residents who are not ordinarily resident. What kind of seemingly unrelated activities can suddenly trigger a filing requirement for them?
That's where it gets particularly interesting, and it reflects a significant policy shift. It's no longer just about your taxable income. Even if your income is below the basic exemption limit, you still might be compelled to file a return if, at any point during the previous year, you engage in certain financial activities or hold specific types of assets.
Okay.
The government is essentially looking beyond just traditional income to capture a broader economic footprint, you could say.
Economic footprint, right.
For instance, if you hold, as a beneficial owner or otherwise, any asset located outside India, you must file. Or if you have signing authority in any account outside India. Even if you're merely a beneficiary of an asset located outside India or derive income from a foreign source or asset, the requirement kicks in.
Wow.
This is a clear move to enhance transparency and track international financial activity and potential undeclared wealth.
So it's not just about earning income, but also about how you live and what you possess, even if it's abroad. What about activities within India that might trigger this, even if you're below the income threshold?
Exactly. The net also broadens for certain significant expenditures. For example, if you've incurred expenditure exceeding a prescribed limit on electricity consumption, maybe say 100,000 rupees in a year.
A lakh, yeah.
Or on foreign travel, like 200,000 rupees. Or if you've deposited an amount exceeding a prescribed limit, say 1 crore rupees, in one or more current accounts. These activities signal a certain level of economic activity or wealth that the tax authorities want to monitor, irrespective of your declared taxable income. it raises a flag.
Let's consider the example of Satman Kanti. She has income well below the basic exemption limit, so you'd think she wouldn't need to file. But if she travels to the USA during the year and incurs 2.2 lakh rupees on that travel,
Boom. Boom, exactly. She's now mandated to file a return.
this really highlights how seemingly minor activities, well, not minor, but non-income activities, can trigger a significant compliance requirement. It's a powerful statement that the government is expanding its data collection beyond just traditional income sources to gain a more holistic view of financial activity.
Yes, it's a move to ensure broader compliance and catch those who might have significant financial transactions or assets but report minimal taxable income. Now, regarding those basic exemption limits for assessment year 2025-26, it depends on which tax regime an individual opts for.
Ah, the regimes, right.
Under the default tax regime, which is laid out in Section 115 BAC, the exemption limit is 300,000 rupees for individuals, Hindu undivided families, HUFs, associations of persons, AOPs, bodies of individuals, BOIs, and artificial juridical persons.
Okay, 3 lakhs.
And this is applied before factoring in certain deductions,
Yeah.
like those under ADC CD2,
Got it.
or various capital gains exemptions under the 54 series.
And if you opt out of that default regime and choose the normal provision,
Then the limits are a bit different. 250,000 rupees for individuals, HUFs, AOPs, BOIs, and artificial juridical persons generally.
2.5 lakhs.
For resident individuals aged 60 to less than 80 years, that limit increases to 300,000 rupees.
Okay.
And for those 80 years or more are super senior citizens, it's a higher 500,000 rupees.
500,000.
Yes. The crucial nuance, regardless of the regime, is that these limits apply to your income before claiming deductions from Chapter 60 and those specified capital gains exemptions. So you look at your gross income before those major deductions.
Got it. That's a key detail.
Transitioning from who must file, let's talk about when they must file. These due dates are critical compliance markers. For companies, and for any person other than a company whose accounts are required to be audited under the Income Tax Act or any other law, the due date is October 31st of the assessment year.
October 31st.
This also applies to a working partner of a firm whose accounts are audited and their spouse, if Section 5A, relating to the Portuguese Civil Code, is applicable.
Then we have a slightly later deadline for a specific category, November 30th of the assessment year. Who falls into that?
This applies to any SSE, including partners or spouses if Section 5A applies, who's required to furnish a report under Section 92E. That section specifically deals with complex international transactions and transfer pricing.
Ah, the transfer pricing, folks.
Exactly. They get a bit more time, understandably.
And for everyone else, the vast majority.
For everyone else, any other assessee not falling into these specific categories, the general due date is July 31st of the assessment year. These dates are hard deadlines, and missing them can trigger consequences.
And speaking of consequences, if you miss that due date, Section 234A comes into play, leading to a financial cost, right? Interest.
That's right. You're looking at simple interest at a rate of 1% per month, or even for a part of a month.
1% per month. Ouch.
This interest starts accruing from the day immediately following the due date and continues until you actually furnish the return or until the assessment is completed, whichever happens first. It's the cost of being late.
So it keeps ticking.
It does. The calculation basis for this interest is important. It's levied on the tax payable on your total income after certain deductions. This means it's reduced by any tax deducted or collected at source. Specific reliefs you might be eligible for under various sections like 89, 90, 90, or 91, and any tax credits allowed under sections like 115 JAA or 115 JD. This provision acts as a clear penalty for delayed compliance, serving as a strong incentive to adhere to the prescribed due dates and manage your tax affairs efficiently.
It's interesting to see that while the net is widening in some areas, the central government also has the power to offer exemptions to ease compliance burdens in others. Section 139, 1C allows them to notify specific classes of persons who can be exempted from filing returns, provided they meet certain conditions. What's the thinking behind this flexibility?
This provision highlights a strategic approach by the government. The aim is to balance maintaining control over tax compliance with promoting ease of doing business, particularly for certain low-risk categories or those they want to encourage, like foreign investment through international financial services centers or IFSCs.
Right, the IFSCs.
For instance, non-corporate, non-residents and foreign companies with income exclusively from investment funds located in IFSCs from assessment year 2019-20 onwards can be exempted. This is if tax is properly deducted at source by the fund under Section 194 LBB and remitted to the central government, and they have no other income requiring a return. It's about simplifying processes for specific, often foreign investors who are already subject to other forms of tax capture.
And there's a similar exemption for certain non-resident eligible foreign investors. If their transactions are only in specified capital assets listed on IFSC stock exchanges, and the consideration is received in foreign currency from assessment year 2021-22 onwards, they can also be exempt. Again, the conditions are similar. Tax must be deducted by the stockbroker under a relevant section and remitted, and they must have no other income. It really seems targeted at making India an attractive financial hub.
Precisely. However, this exemption isn't a carte blanche to ignore tax authorities altogether.
Ah, there's always a catch.
Well, it becomes non-available or void if the assessee is issued notices for filing returns under sections like 142.1, 148, 153A, or 153C. So while it offers relief for streamlined transactions, it doesn't shield you if the taxman has a specific reason to scrutinize your affairs.
Okay, that makes sense. Moving from income to the other side of the ledger, what if you've incurred a loss? If you've had a bad year financially, you need to file a return of loss under Section 139.3. This is essential if you want to use those losses to offset future gains, but I understand the rules are quite specific depending on the type of loss.
Absolutely. For specific types of losses, filing your return by the original due date under Section 139.1 is absolutely critical if you want to carry them forward to future years.
Which ones are those?
These include business losses under 73.1, speculation business losses under 73.4, losses from specified businesses under 73.3, capital gains losses under 74, and losses from owning or maintaining racehorses under 74A3. If you miss that due date for these, you effectively forfeit your ability to carry them forward and utilize them later.
That's a massive consequence. But you mentioned a crucial distinction, a common point of confusion for many. What are the exceptions where that strict due date isn't a deal breaker for carrying forward losses?
This is a vital nuance, and it often surprises people. Losses under income from house property, covered by 71B, and unabsorbed depreciation under Section 32 do not require the return to be filed by the due date for them to be carried forward.
Really? That's huge.
Yes, this was clearly established in the 2011 case of CIT Bev Govinda Nagar Sugar Ltd. The court ruled that unabsorbed depreciation, for example, essentially becomes part of the next year's depreciation allowance, so the strict due date for the return doesn't apply to its carry-forward benefit.
Interesting legal point.
The overarching principle here is that filing a return of loss is fundamentally in your own best interest. You cannot claim that you weren't notified and thus exempt from the consequences.
So if you want to use your losses to offset future gains and reduce your tax burden, timing is everything for certain types of losses. But it's equally important to know which losses offer a bit more leniency in terms of filing deadlines.
Exactly. What happens if, despite all the deadlines, you still miss the original due date? That's where the concept of a belated return comes in, defined under Section 139.4. This is simply any return furnished after the due date specified in Section 139.1.
So there's a window of opportunity to rectify a missed deadline, but it comes with a cost, right?
Yeah.
What are the practical consequences for a taxpayer who files a belated return?
The time limit to file a belated return allows you to furnish it at any time before 3 months prior to the end of the relevant assessment year, for instance, December 31st, 2025, for the previous year, 2024-25, or before the completion of your assessment, whichever is earlier. So there's a window.
The consequences.
Yes, the consequences for being late are quite clear and can be significant for your financial planning.
Okay, like what?
Firstly, as we just discussed, you generally cannot carry forward most types of losses, with the key exceptions being house property loss and unabsorbed depreciation. Secondly, you lose certain specific deductions, for example, those linked to industrial undertakings under ADIA, ADIB, or SEZ units under TENABELA, or even the 80JJAA deduction for new employment.
Ouch, losing deductions hurts.
It does. You'll also incur a fee under Section 234F, 5,000 rupees if your total income is more than 5 lakhs, and 1,000 rupees if it's 5 lakhs or less. And a big one, starting from assessment year 2024-25, if you file a belated return, you cannot opt out of the default tax regime under Section 115 BAC. You must pay taxes as per that regime.
Wow, so you lose the choice of regime, too.
Yes. This is where the cost of noncompliance becomes very clear. Missing the due date doesn't just mean a fee. It can fundamentally alter your ability to reduce future tax liabilities or choose your preferred tax structure, leading to potentially higher tax outcome.
Beyond individuals and companies, there are specific rules for other significant entities in society, like charitable trusts and political parties, which receive special tax treatment. How do they fit into this filing framework?
These provisions ensure transparency and compliance for entities that receive special tax benefits. For charitable trusts and institutions, they must furnish a return if their total income before claiming exemptions under Sections 11 and 12.
Which deal with their core charitable income, right?
Correct. Income from property held for charitable or religious purposes. If that income before exemptions exceeds the basic exemption limit, they have to file. Their due date is typically October 31st if their accounts are required to be audited.
And political parties.
Similarly, for political parties, their chief executive officer is mandated to file a return if their income, before claiming exemption under Section 13A, which exempts certain incomes for political parties, exceeds the basic exemption limit.
Okay, so ensuring transparency across the board. And these specific mandatory filing requirements extend to a whole host of other entities too, like universities, hospitals, research bodies.
Precisely. The common theme across all these specific entities ranging from colleges and hospitals under 139.4c, research associations and news agencies under 139.4d, business trusts under 139.4e, to investment funds under 139.4f is that they all have mandatory filing requirements if their income for specific exemptions applicable to them exceeds the basic exemption limit.
So even with special status, basic reporting is needed.
Absolutely. All general provisions of the Income Tax Act apply to these returns as if they were filed under the primary Section 139. This reinforces the principle that special status doesn't mean exemption from basic reporting and transparency.
So what if you've done your due diligence, filed your return, and then a few weeks or months later you discover a mistake, maybe an omission or something you stated incorrectly? Is there a safety net for that, or are you just, stuck?
Thankfully, there is a very important safety net: the revised return under Section 139.5. If you discover any omission or wrong statement, in a return you've already furnished, whether it was an original return under 139.1 or even a belated one under 139.4, you absolutely can furnish a revised one. It's a crucial mechanism for self-correction.
That's a huge relief. What's the window for doing this, and can you revise it multiple times?
The time limit for furnishing a revised return is quite generous. You can do it at any time before 3 months prior to the end of the relevant assessment year again. For the previous year, 2024-25, that would be December 31st, 2025, or before the completion of your assessment, whichever is earlier.
Okay, same deadline as the belated return then.
Yes, same final cutoff. And yes, you can revise your return multiple times within this time frame. The latest revised return completely replaces any earlier ones, so only your most recent submission is considered valid. This flexibility also extends to other types of returns, such as those filed by charitable trusts or political parties.
So there's a safety net if you catch a mistake, but you have to use the right process to fix it. You can't just send a note.
Absolutely not. And here's a critical practical point, underscored by cases like Orissa Rural Housing Development Corp. LTDV ACIT, and Goetze India LTDV CIT. If you want to make a fresh claim, say, for a deduction you initially overlooked and didn't take, you must do it by filing a revised return.
Must use the revised return.
Yes. A simple letter or an informal revised statement sent to the tax department won't cut it. Think of it like submitting an updated resume for a job application. You can't just send an email with a note saying, oh, by the way, I also have this skill. You need to submit the official updated document. You have to use the right prescribed process.
Got it. What about the information in the return? It seems they ask for a lot more than just income these days.
They certainly do. The tax authorities want a very comprehensive picture of your financial life. Under Section 139(6), the prescribed return forms require you to furnish a significant amount of information beyond just your income. This includes details of income that is exempt from tax.
Even exempt income.
Yes. Also, any prescribed assets you hold, whether as a beneficial owner or otherwise, or if you are simply a beneficiary of those assets, all your bank accounts and credit cards, certain expenditures that exceed prescribed limits, and any other prescribed outgoings.
So it's not just about what's taxable, but your entire financial footprint. And for businesses or professions, Section 139(6)(a) adds even more specifics, right?
Yes. For those engaged in a business or profession, you're required to provide additional details, such as information about partners or members in firms, AOPs or BOIs, and their respective shares in the profits. This extensive data collection is mandated by tax authorities to build a complete and granular financial profile of the SSC.
Mm.
It helps them piece together a holistic view of your economic activities, ensuring a more accurate assessment.
Okay, now what if you file, but there's something wrong with the return itself? Not necessarily the numbers, but maybe missing documents. Is it just rejected?
Not immediately. The assessing officer, or AO, has a crucial power to identify and address a defective return under Section 139. If the AO determines that your return of income contains a defect, they don't just reject it outright. Instead, they can intimate or notify you of the defect and provide you with an opportunity, typically 15 days, which can be extended if you request to rectify it.
A chance to fix it.
Exactly.
Oh.
However, if you fail to rectify it within that given period, the return is then treated as invalid, as if it was never filed.
What kind of things would make a return defective? Is it just typos or something more substantial?
It's usually more substantial. Common examples of a defective return include missing mandatory financial statements, such as your profit and loss account or balance sheet, a missing tax audit report if one is applicable to your case, or even missing proof of tax payments like tax deducted at source (TDS), advance tax, or self-assessment tax. These are fundamental pieces of information that the AO needs for proper assessment.
Makes sense.
However, there's an important exception. A return isn't considered defective if, for instance, a TDS or TCS certificate wasn't furnished under the relevant sections, provided you produce it within 2 years. This provision acts as a crucial quality control mechanism, allowing for corrections without outright rejection for curable flaws. It balances the need for strict compliance with practical realities.
And there's also something about minor mistakes not invalidating the whole thing.
Yes, a profound insight from Section 292B, often referred to as the principle of substance and effect, means that a return isn't invalidated by minor technical mistakes if it substantially conforms to the Act's intent. This prevents small, trivial errors from completely invalidating an entire filing, focusing on the core purpose of the return.
Good to know. Now, there's a relatively new provision effective from the Finance No. 2 Act 2024, Section 139(9)A. What does this cover?
Right. If a return is furnished following a specific order from the CBDT under Section 119(2)B, which allows the board to issue general or special orders for the purpose of proper and efficient management of the Act, then all provisions of the Income Tax Act apply as if it were a regular return required under Section 139(1).
So it just clarifies the status of those returns.
Exactly. This formalizes the treatment of returns filed under these specific relaxation or instruction orders issued by the CBDT. It provides legal clarity for situations where the board might, for instance, extend a deadline or simplify a process for certain taxpayers.
Okay. And just quickly, those fees for filing late again, Section 234F.
Just a quick reiteration on the fees for default in furnishing a return, which we touched upon earlier. It's a fixed amount designed to encourage timely compliance. It's 5,000 rupees if your total income is more than 5 lakhs, and it drops to 1,000 rupees if your total income is 5 lakhs or less. These fees are a straightforward penalty for non-compliance with filing deadlines.
Got it. Now, let's talk about big corporate shifts. Mergers, demergers, amalgamations. These aren't just business decisions. They have massive tax implications. What happens to tax filings when a company fundamentally reorganizes itself?
That's where Section 170A comes in, dealing with modified returns in cases of business reorganization. This is a crucial detail for ensuring that tax records accurately reflect the new reality post-merger or demerger, and it has specific timelines.
Modified returns.
Yes. If a return was filed before a high court, tribunal, or adjudicating authority issued an order for such reorganization, the successor entity, meaning the company that comes into existence or continues after the reorganization, has a specific requirement.
So the new entity has to essentially go back and refile.
Exactly. The successor entity must file a modified return in a prescribed form, Form ITRA. This needs to be done within 6 months from the end of the month in which the reorganization order was issued. This provision applies regardless of the usual filing requirements under Section 139.
And how does that affect the assessment?
The impact on assessment depends on whether the original proceedings were completed or pending. If they were completed, the AO modifies the total income based on the reorganization order and the modified return. If proceedings were pending, the AO completes the assessment or reassessment based on the order and the modified return. This ensures the tax records align precisely with the new corporate structure and its financial history. Let's use an example to clarify. If A Ltd merges with B Ltd effective April 1, 2023, but the court order sanctioning this merger is dated November 1, 2024.
Then BLTD, even if it had already filed its original return for assessment year 2024-25, must now file a modified return
And the deadline.
within 6 months from the end of November 2024, so by May 31st, 2025. It's about ensuring that the tax obligations and structure align perfectly with the legally formalized business reorganization. Okay, clear. All right, let's pivot to the very backbone of financial identification in India. The permanent account number, or PAN, and Aadhaar. These aren't just random numbers. They're essentially your financial fingerprints, central to almost every significant financial interaction.
Absolutely. Section 139A makes it mandatory for several categories of persons to apply for a PAN. Firstly, if your total income or the total income of any other person for whom you're assessable exceeds the basic exemption limit in any previous year, you must apply for a PAN on or before May 31st of the assessment year. That's a fundamental requirement.
But it's not just about earning over a certain income anymore, right? It seems the government wants a financial identifier for anyone involved in substantial financial activities, even if their income is low. What are some of those triggers?
You're spot on. If you're carrying on any business or profession and your total sales, turnover, or gross receipts are likely to exceed 5 lakhs in any previous year, you need to apply for a PAN before the end of that financial year.
5 lakhs turnover. Okay.
The same deadline applies to charitable trusts and institutions that are required to file a return. Furthermore, any resident other than an individual who enters into a financial transaction aggregating to 250,000 rupees or more in a financial year must also apply for a PAN before the end of that financial year.
2.5 lakhs in transactions for entities?
Yes, the CBDT has even broadened the scope further by introducing new Rule 114BA transactions for those without a PAN. For example, if you plan to deposit or withdraw cash totaling 20 lakh rupees or more in your bank or post office accounts during a financial year.
20 lakhs cash.
Yes, you need to apply for a PAN at least 7 days before you intend to cross that limit. Similarly, if you intend to open a current account or cash credit account with a bank or post office, you must apply for PAN at least 7 days before opening the account. It's about ensuring that substantial financial flows are linked to a unique identifier right from the outset.
So it's not just for those earning above a certain threshold, but for anyone involved in significant financial activities. It's truly becoming your digital financial fingerprint, required for entry into a wide range of transactions.
Exactly. The central government also has powers to allot PANs in other scenarios, for instance, for specific classes of persons or based on prescribed transactions, and even the assessing officer can allot a PAN if they deem it necessary.
And the Aadhaar link.
What's also key is the Aadhaar as deemed PAN application rule. If you possess an Aadhaar number and quote it in lieu of a PAN, or apply for a PAN by intimating your Aadhaar, you're deemed to have applied for PAN without needing to submit additional documents under Rule 114. This is a practical step to streamline the process for citizens who already have an Aadhaar.
Okay. Once you have a PAN, quoting it becomes mandatory in an incredibly vast array of documents and transactions. This isn't just a formality, it's about being visible to the tax authorities across your entire financial life. Can you give us a sense of the sheer breadth of transactions where PAN is now required, it seems like? Almost everything's significant.
It really is comprehensive. You must quote your PAN in all returns filed with or correspondence sent to any income tax authority and on all challenges for tax payments. But the list of prescribed transactions under Rule 114B is exceptionally detailed and covers nearly all major financial activities. Think of it this way. Almost any significant financial activity, from buying a car to depositing large sums of cash, now requires your financial fingerprint, your PAN or Aadhaar.
Give us some examples. Cars, bank accounts.
Yes, it's mandatory for the sale or purchase of any motor vehicle other than a two-wheeler. For opening any bank account, with a few minor exceptions like basic savings accounts, applying for a credit or debit card, or opening a debit account where you hold securities electronically, all require your PAN.
What about cash? Big cash payments.
It even extends to cash transactions. Paying a hotel or restaurant more than 50,000 rupees in cash, or paying more than 50,000 rupees in cash for foreign travel or foreign currency, triggers the requirement.
50,000 cash. So a large cash payment, even for something like a vacation, can trigger this. What about investments or other common financial activities?
Yes. For investments, if you're making payments to a mutual fund for units exceeding 50,000 rupees, or paying more than 50,000 rupees for debentures, bonds, or RBI bonds, PAN is mandatory.
Okay. And cash deposits.
For cash movements, depositing more than 50,000 rupees in cash in a bank or post office in any one day, or purchasing bank drafts, pay orders, or banker's checks in cash exceeding 50,000 rupees in any one day are covered.
Who day limits there?
Yes. For time deposits like FDs, the limit is more than 50,000 rupees in a single transaction, or aggregating to more than 5 lakh rupees during a financial year, whether with a bank, post office, NIDI, or non-banking financial company, NBFC.
Okay, the aggregate over a year matters too.
It does. It also covers aggregating more than 50,000 rupees in a financial year for prepaid instruments or life insurance premiums exceeding 50,000 rupees annually.
Life insurance too, wow.
And for property or securities. Contracts for sale or purchase of securities other than shares, exceeding 1 lakh rupees per transaction, or sale purchase of unlisted company shares exceeding 1 lakh rupees per transaction. For immovable property, if the sale or purchase amount exceeds 10 lakh rupees, or if the stamp valuation exceeds 10 lakh rupees, PAN is mandatory.
10 lakhs for property.
And finally, for the sale or purchase of any other goods or services, if the amount exceeds 2 lakh rupees per transaction, you must quote your PAN. This exhaustive list clearly demonstrates the breadth of financial activities that the tax authorities are monitoring. It's not just about earning income, but also about how you transact and spend.
It's truly comprehensive. What about specific situations, like for minors, or if you don't have a PAN yet, how does that work?
Good points. If a minor enters into one of these transactions and doesn't have income chargeable to tax, they quote their parents' or guardian's PAN. And if you don't have a PAN but need to conduct a specified transaction, you must do a declaration in Form 60 explaining why you don't have one.
Form 60, okay.
This rule also applies to foreign companies operating in IFSC banking units for certain transactions.
Are there any exceptions, like government transactions?
Yes. It's important to note that Rule 114B generally doesn't apply to central or state governments or consular offices. Also, non-residents are exempt for most transactions, except for a few specific ones like motor vehicle sales, bank account opening, demat accounts, mutual funds, and immovable property, among others.
And the person receiving the PAN also has a responsibility.
Critically, yes. Those receiving documents for these listed transactions are obligated to ensure a PAN is quoted. And if your address or business name changes, you must intimate the AO. Likewise, payees or buyers must intimate their PAN to the TDS/TCS deductor or collector, who in turn must quote it in certificates and statements. There are some limited exemptions to this intimation requirement if you have no taxable income and furnish a declaration that your estimated tax is nil.
This interchangeability of PAN with Aadhaar is a huge shift, making Aadhaar a de facto financial identifier. It streamlines things for many, but it also comes with its own set of rules, doesn't it? What was the primary driver for this integration?
Well, from September 1st, 2019, you can furnish, intimate, or quote your Aadhaar number in lieu of your PAN in many situations. This is permitted if you haven't been allotted a PAN but possess an Aadhaar, or if you've already been allotted a PAN and have intimated your Aadhaar to the prescribed authority.
So Aadhaar can substitute PAN in many cases.
Yes. The primary driver for this was simplification and increased compliance by leveraging the widespread adoption of Aadhaar. The government aims to create a more integrated and efficient tax identification system.
And it involves authentication, too.
It does. This is a significant move towards integration. For prescribed transactions, it's now mandatory not only to quote your PAN or Aadhaar number, but also to authenticate it in the relevant documents. And those receiving such documents must ensure both quoting and authentication. Rule 114BB specifies particular transactions requiring this, such as cash deposits or withdrawals aggregating to 20 lakhs or more in a financial year, or opening current or cash credit accounts. Certain exclusions apply, like for central state government, consular office, or non-residents without income chargeable in India when dealing with IFSC banking units.
Given how crucial PAN and Aadhaar are, I imagine there are significant penalties for noncompliance. What happens if you fail to adhere to these rules? Section 272B, right?
You're absolutely right. The penalties are significant and designed to strictly enforce adherence to the PAN provisions under Section 272B. If you simply fail to comply with Section 139A, meaning you don't apply for a PAN when required, the penalty is 10,000 rupees. Straightforward.
Okay, 10K for not applying.
But it gets more granular and potentially much more expensive. For example, failing to quote your PAN or Aadhaar number in specified documents, or knowingly quoting a false number, or failing to intimate your PAN or Aadhaar to a deductor or collector, each attracts a penalty of 10,000 rupees for each such default.
Each default, so it adds up fast.
Very fast. If you make the same mistake multiple times, the penalties add up very quickly. The same 10,000 rupees per default penalty applies if you fail to quote or authenticate PAN or Aadhaar in documents referred to in 139A6A.
And it's not just the person providing the PAN who's liable, but also the person receiving it if they don't ensure compliance.
Precisely. That's a strong incentive for everyone involved in a transaction. If you are the one receiving documents for specified transactions, and you fail to ensure that the PAN or Aadhaar is duly quoted or authenticated by the other party, that's also a 10,000 rupee penalty for each such default.
Okay, let's use that Mr. Raghav example again. He quotes the wrong PAN for a 75K cash payment for foreign travel. What's the hit?
He's liable for a 10,000 rupee penalty for each instance of quoting a false PAN. The destination, whether it's Saudi Arabia versus Nepal, doesn't change the PAN requirement if it's foreign travel over the 50K cash threshold. It's important to remember that an opportunity to be heard must generally be given by the tax authority before imposing such penalties, ensuring due process.
Right, due process. Now, Section 139AA, this is about quoting Aadhaar itself, especially the linking requirement.
Yes, Section 139AA made quoting the Aadhaar number mandatory for anyone eligible to obtain it, starting July 1st, 2017. This means you need to provide it in your PAN application form and in your income tax return. Previously, if you didn't have an Aadhaar, you could quote your enrollment ID.
But this is a big one and a crucial recent change that many might miss. With effect from October 1st, 2024, Aadhaar enrollment ID cannot be furnished in place of the Aadhaar number. This means if you relied on your enrollment ID before, you'll now absolutely need to have your actual Aadhaar number.
That's a key change, yes.
If you were allotted a PAN based on your enrollment ID before that date, you'll need to link your actual Aadhaar number by a date to be notified by the government.
Absolutely. All PAN holders as of July 1st, 2017, who were eligible for Aadhaar, were initially required to intimate their Aadhaar number by March 31st, 2022. If you failed to link your Aadhaar number by this date, your PAN became inoperative.
Inoperative. That sounds serious.
It is. This has serious real-world consequences under Rule 114 Abale, effectively putting your financial dealings on hold or making them more expensive.
Your PAN literally goes inoperative if you don't link it to Aadhaar. No refunds, higher taxes withheld. This isn't just a slap on the wrist. It's a very strong push for integration and compliance by the government. What are the specific headaches it creates?
Indeed. If your PAN is inoperative, you'll first be liable for a fee for late intimation under Section 234H, 500 rupees if you link it within 3 months by June 30th, 2022, and 1,000 rupees in all other cases.
So fee first.
Beyond that, and this is where it really bites, from July 1st, 2023, until your PAN becomes operative again, you face several compounding consequences. No refund of tax will be made to you.
No refunds.
No interest will be payable on any refund that might be due.
No interest either.
And you'll face a higher rate of tax deducted at source, PDS, under Section 206 Bul A, and a higher rate of tax collected at source, TCS, under Section 206 CC.
Higher TDS and TCS. Ouch.
Essentially, your financial life becomes significantly more complicated and costly until you rectify it. Your PAN only becomes operative again within 30 days of successful intimation and fee payment.
However, there are some specific exemptions from this Aadhaar quoting requirement under Section 139AA, isn't that right? Who gets a pass?
Yes, there are a few categories for whom this mandatory linking does not apply. This generally includes individuals residing in Assam, Jammu and Kashmir, or Meghalaya. It also exempts non-residents as per the Income Tax Act, individuals who are aged 80 years or more at any time during the previous year, and those who are not citizens of India. These exemptions recognize specific circumstances or historical contexts.
Okay. Now that we've covered the fundamentals of filing your return and establishing your identity with PAN and Aadhaar, let's explore some of the supporting mechanisms that aid the tax department in its assessment process. These are the tools and rules that ensure the system functions smoothly, or at least tries to, starting with TRPs.
Right, tax return preparers. The CBDT has the power to notify a scheme for specified classes of persons to file returns through TRPs under Section 139B. The core purpose of TRPs is to assist taxpayers, particularly smaller ones, in preparing and furnishing their returns. They act as a helpful intermediary, and they also affix their signature to the return, signifying their involvement.
So TRPs are meant to make tax filing easier for some. But what are the boundaries? Can just anyone be a TRP or use one? Who's excluded?
That's a crucial point, as there are strict rules about who cannot be a TRP. An officer of a scheduled bank, a legal practitioner, a chartered accountant, or an employee of the specified class of persons they are assisting cannot act as a TRP. This prevents conflicts of interest and ensures a certain level of independence.
Okay, so no bankers or CAs as TRPs. And who can use them?
And critically, Who are these specified class of persons who can use TRPs? Any person other than a company or a person whose accounts require a tax audit under Section 44AB or any other law.
So basically, individuals and smaller businesses whose accounts aren't audited.
Precisely. This clearly means TRPs are primarily designed to help smaller individual taxpayers or non-audited entities navigate the system.
Yeah.
It's important to note the restrictions on who can use a TRP as well. Individuals or HUFs cannot use a TRP if their accounts require an audit or if they're non-residents. Furthermore, you cannot file a revised return through a TRP unless the original return was also filed through a TRP. And if you've received notices under Section 142(1) or 148, which initiate inquiries or reassessments, you cannot file your response through a TRP.
So if X's accounts are audited under Section 44AB, they cannot use a TRP. This clearly reinforces the strict definition of specified class of persons. It's a system designed to help, but with very clear boundaries to prevent overreach or misuse, especially in more complex tax scenarios.
Verification of the return is far from just a formality. It's about legal accountability. Section 140 specifies exactly who is authorized to verify the return of income, depending on the assessee's type and specific circumstances. This ensures that a responsible individual is officially signing off on the accuracy of the information provided to the tax department.
So for different types of entities, it's a specific person who holds that legal responsibility. Can you give us a few examples of who's on the hook for verifying? Who signs the return?
Absolutely. For an individual, it's typically the individual themselves. However, if they are absent from India or are incapacitated, then an authorized person holding a valid power of attorney, POA, which must be attached to the return, or their guardian can verify it.
Okay, POA is key there.
Yes. For a Hindu undivided family, or HUF, the Karta is the authorized person, or if the Karta is absent or incapacitated, any other adult member can step in.
The CARTA, right.
For a company, it's usually the managing director. If the MD is unable to act, or if there's no MD, then any director or other prescribed person can verify. If it's a non-resident company, their MD or a person with a power of attorney must verify. And quite practically, if a company is being wound up, the liquidator takes on that responsibility.
Liquidator makes sense. Firms, LLPs.
For a firm, it's the managing partner, or any other partner who is not a minor if there is no managing partner. For a limited liability partnership, LLP, it's the designated partner or any other partner if the DP is unable or there's no DP. A local authority's return is verified by its principal officer, and for a political party, it's their chief executive officer. Knowing who is ultimately responsible for signing off on a tax return is crucial for compliance, as it directly links the legal entity to the individual who stands accountable for the accuracy of the information.
Before you even hit submit on your return, there's a crucial step called self-assessment under Section 140A. What's the fundamental principle behind this, and why is it so important for the overall tax system? Seems like you pay before they even check.
That's exactly it. Self-assessment is truly the bedrock of voluntary compliance in our tax system. It represents a fundamental shift in responsibility, placing the initial burden of calculation and payment squarely onto the taxpayer prior to any official assessment by the tax authority.
Yeah, okay, pay first.
Yes. Every SSE is required to calculate and pay the full amount of tax, any applicable interest, and any fees due on the income declared in their return, whether that return is filed under the regular provisions or in response to specific notices for inquiry or reassessment.
So you do the math and you pay it before the tax department even formally reviews your return. What if your payment falls short? Is there a specific order for how any shortfall is adjusted?
Yes. This calculation takes into account any advance tax already paid, any tax deducted at source, TDS, or tax collected at source, TTS, and various other tax reliefs or credits you might be eligible for. If your payment falls short of what's fully due, there's a specific order of adjustment mandated by law. First, the payment is adjusted towards any fee.
Fee first.
Then towards any interest.
Interest second.
And finally, towards the actual tax liability. If you fail to pay the whole or any part of what's due as per your self-assessment, you are deemed in default as an SSE, which can trigger further consequences. It's a powerful mechanism that ensures a significant portion of tax collection happens through voluntary compliance.
This is a relatively new and very important provision introduced by the Finance Act 2022, the updated return under Section 139(8)(a). It's been called a significant second chance for taxpayers. Even if you miss the window for a revised return, you might get another shot to correct your income. But there's a big catch, isn't there? You can only file one if it means more tax for you, not less. Is that right?
Precisely. That's the key condition. This provision allows any person to furnish an updated return at any time within 24 months from the end of the relevant assessment year. For instance, an updated return for assessment year 2025-26 could be filed all the way up to March 31st, 2028.
24 months. That's a long window.
It is a considerable extension beyond the limits for a revised return, offering a much wider window for corrections. It can be filed irrespective of whether you furnished an original, belated, or revised return previously, or even if you didn't file any return at all.
So it's a broad opportunity for course correction. But you mentioned the catch. What are the scenarios where this second chance is not available? When can't you file an updated return?
That's the crucial part, and it underscores the policy intent. You cannot file an updated return if it is a loss return,
No loss returns.
or if it decreases your total tax liability from your previous return,
Can't reduce tax.
or if it results in or increases a refund from a previous return.
Or get a bigger refund. Okay.
This prevents taxpayers from using it to simply reduce their tax burden or claim new refunds after the original deadlines have passed. The idea is to promote additional compliance and revenue, not provide another chance for tax reduction.
And if you're already under scrutiny?
Furthermore, it gets more restrictive if you're under the tax department's scrutiny. You cannot file an updated return if a search under Section 132 or a requisition under Section 132A has been initiated against you, or if a survey under Section 133A, other than for TDS-TCS verification, has been conducted. You're also barred if a notice has been issued stating that seized money or documents belong to you, or if prosecution proceedings have already been initiated, or if information has been received under a bilateral agreement or double taxation avoidance agreement, DTAA. The system is designed for genuine voluntary correction of underreported income, not as a loophole to evade ongoing investigations.
However, it is allowed in specific scenarios. For example, if your original return was a loss return, but your updated return results in an income return.
Correct. That's permitted.
And a key consequence to note, if your updated return reduces any carried forward loss, unabsorbed depreciation, or tax credit that you claimed for a subsequent year, you'll also be required to furnish an updated return for those subsequent years to accurately reflect the changes you've made.
That's an important domino effect, yes.
Yeah.
It maintains consistency across years.
So if you're filing an updated return, there's a price tag for that second chance, and it's called additional income tax under Section 140B. How is that calculated, and what's the logic behind it? Seems like a penalty for waiting.
Yes, this additional income tax is designed to act as a deterrent against simply using the updated return as a routine compliance mechanism, ensuring it's for genuine corrections, not just prolonged procrastination. It's essentially the price of that second chance. The tax, this additional tax, interest, and any fees must all be paid before you furnish the updated return.
Pay upfront.
Yes, and critically, proof of payment is mandatory. If it's missing, your updated return will be treated as defective and invalid.
How's the calculation done? Does it matter if you filed before?
The calculation varies based on whether you furnished an earlier return or not. If no earlier return was filed, you pay tax on the updated income, plus interest under 234A and 234B, plus fees, 234F, and this new additional income tax. If you did furnish an earlier return, the calculation considers the tax on your updated income after adjusting any credit from the earlier return, plus interest, with 234B on assessed tax and 234C based on updated return income, and the additional income tax. Any refund you receive from the earlier return is added back to your current liability.
And the rate of this additional tax changes depending on how long you waited to correct your income. More delay, more tax.
Exactly. The rate of this additional income tax increases with the delay, reinforcing the incentive for earlier correction. It's 25% of the aggregate of the tax and interest payable if you furnish the updated return within 12 months from the end of the relevant assessment year after the expiry of the 139 windows for belated or revised returns.
25% if within 12 months.
However, if you file it between 12 and 24 months from the end of the relevant assessment year, that additional income tax jumps significantly to 50% of the aggregate of tax and interest payable.
Doubles to 50%. Wow.
So, using Mr. X as an example, for assessment year 2024-25, if he files his updated return on March 31st, 2026, which is within 12 months from the end of AY 2024-25, his additional tax is 25%. But if he waits and files it on February 28th, 2027, which falls between 12 and 24 months, that additional tax doubles to 50%, That clearly penalizes longer delays in correction and truly makes it the price of a second chance, rather than a loophole.
All right, with our returns filed and any self-corrections made, we now move into the actual assessment process. This is where the tax authorities actively engage to verify and finalize your submitted information. It's like the tax department's very own detective work, starting with inquiries.
Yes, Section 142 grants the assessing officer, or AO, the power to make inquiries even before a formal assessment begins, and regardless of whether a return has even been filed. This is the taxman's Sherlock Holmes stage, designed to obtain full and accurate information for assessment.
So the AO can just start digging without you even filing? What kind of powers do they have to get this information? Can they ask for anything?
They have broad powers here, typically exercised by serving a notice. They can require you to file a return if you haven't done so by the 139 due date, effectively compelling compliance. They can also demand the production of specific accounts or other documents they deem necessary for their inquiry. And they can require you to provide written information on specific points or matters, which can even include a statement of all your assets and liabilities, irrespective of whether they're recorded in your formal books of account. This allows them to build a comprehensive financial picture.
Okay, so they can ask for a lot. Are there limits? How far back can they go?
Yes, even the AO has limits on how far back they can dig without special permission. They cannot ask for accounts or documents relating to a period more than 3 years prior to the previous year.
3 years back, okay.
And to ask for a statement of assets and liabilities not included in your regular accounts, they need the prior approval of a joint commissioner.
Higher approval needed for that.
Right. While the law doesn't specify a time limit for issuing a 142.1 notice, it's generally understood to be within the overall assessment completion period. And importantly, if inquiry material gathered through this process is used for your assessment, you must be given an opportunity to be heard, ensuring fairness, unless it's a best judgment assessment under Section 144 where you fail to cooperate entirely.
Sometimes the AO's detective work gets too complex and they need to bring in specialist help. This is where a special audit or inventory valuation under Section 142(2)A comes in. How does the tax department decide when to call in these experts? Is it common?
It's not routine, but it's a powerful tool for the AO when the financial picture is unclear, unusually complex, or there are serious doubts about its accuracy. A direction for a special audit or inventory valuation can be issued if the AO believes it's necessary due to the nature or complexity of the accounts, the sheer volume of accounts, doubts about the correctness of the accounts, the multiplicity of transactions, or the specialized nature of the business activity, and crucially, it must be in the interest of revenue. It's not an arbitrary decision.
So there's a high threshold. What's the formal procedure for directing such a specialized audit? Do you get a say?
The procedure is quite formal and involves significant checks and balances. The AO first needs previous approval from a very senior authority, either the principal chief commissioner, principal commissioner, or commissioner.
Top brass approval.
Yes. You, the assessee, must also be given an opportunity of being heard before such a direction is made, allowing you to explain why you think a special audit might not be necessary. If approved, the AO directs you to get your accounts audited by a chartered accountant nominated by the tax department, or your inventory valued by a nominated cost accountant.
And who pays for this?
The expenses of this special audit or inventory valuation are determined by these senior tax authorities and are paid by the central government, so it's not a direct cost to the assessee.
That's good to know.
Interestingly, this special audit can even be mandatory if your accounts are already audited under other laws, highlighting the specific nature of this inquiry. You're generally expected to furnish the report within 180 days of receiving the AO's direction, though extensions can be granted. If you fail to comply, the AO can then make a best judgment assessment under Section 144 and/or impose a penalty.
What if the nominated CA refuses?
A profound insight from the Swadeshi Polytex Ltd v. ITO case from 1983 is that if the nominated chartered accountant or cost accountant refuses to audit or value, the assessee is not liable for consequences. The AO must then appoint another. This provides an important layer of protection for the assessee against factors beyond their control.
Beyond financial auditors, the AO can also call in valuation experts for assets, right? Section 142A. So if they suspect an undervaluation or overvaluation of an asset, they can get a third-party opinion.
Precisely. The interesting part here is that the AO can make this reference whether or not they are already satisfied about the correctness or completeness of the assessee's accounts.
Really? Even if they don't have doubts?
Yes. This means they don't need a pre-existing doubt to seek an expert valuation. The valuation officer, a specialist in property or asset valuation, must give the assessee an opportunity of being heard and consider the evidence provided. If the assessee doesn't cooperate, the valuation officer can make a best judgment estimation based on available information. Ultimately, the AO will consider the valuation officer's report after giving the assessee another opportunity to be heard when making the final assessment. This ensures that assets are valued fairly and accurately for tax purposes.
This sounds like the future of tax administration moving to a completely digital, impersonal, and highly efficient system, leveraging technology, even AI, to assign cases and conduct inquiries. How is this faceless approach under 142B changing things for inquiries and valuations?
That's a critical transformation. Section 142B empowers the central government to notify a scheme for completely faceless processes for various inquiries and valuations. This includes issuing notices for information, making general inquiries, directing special audits, or making references to valuation officers. The core objectives are a massive leap in efficiency, transparency, and accountability by eliminating physical interface between the taxpayer and the tax officer.
No more visiting the tax office.
Largely, yes.
Yeah.
Optimizing resource utilization and introducing a team-based approach with dynamic jurisdiction, often through automated allocation using AI and machine learning.
So it's not one officer handling your case from start to finish. It gets passed around digitally.
Correct. Notification number 19-2022 confirmed that faceless inquiry and valuation will be conducted through automated allocation, following procedures similar to the broader faceless assessment under Section 144B. This means cases are assigned dynamically to various units across the country, aiming to reduce human bias, increase standardization, and speed up the process. It's a significant modernization effort, fundamentally changing how these preliminary steps in assessment are conducted.
Okay, now we come to the actual assessment itself, the formal determination of your tax liability. This starts with a preliminary, largely automated process, doesn't it? The Section 143(1) intimation.
That's the summary assessment, or intimation, under Section 143(1). This is a computerized preliminary assessment of returns filed under Section 139 or in response to a 142 notice. Think of it as an automated pre-check of your return. During this process, the system can make certain automatic adjustments to your returned income.
What kind of adjustments are automatic? Can they just change anything, or is it only obvious errors?
No, not just anything. The adjustments are limited to errors that are apparent from the return itself. These include simple arithmetical errors or incorrect claims that are immediately obvious from the information you've provided.
Like adding wrong or claiming something impossible based on the form?
Exactly. For example, if your entries are inconsistent, if you're missing substantiating information for a claim, or if you've claimed a deduction that clearly exceeds the statutory limit. It can also include the disallowance of a loss if the return for the previous year for which set-off is claimed was filed beyond the due date, or the disallowance of expenditure or an increase in income indicated in an audit report but not accounted for in your return. Similarly, certain deductions like 10LA or Chapter 6A Part C might be disallowed if the return was filed after the original 139 due date.
Okay. And then you get a notification.
Once these automated checks are done, an intimation, essentially a notification, is generated and sent to you within 9 months from the end of the financial year in which the return was made. This intimation specifies whether there's a sum payable by you or a refund due to you. If an amount is payable, this intimation serves as a formal notice of demand, and failure to pay within 30 days makes you in default.
So that's the automated initial check. But if the tax department wants a closer, more detailed look, that leads to a scrutiny assessment, right? Section 143, 2 and 3.
Yes, moving on from the automated intimation, we have the more detailed scrutiny assessment under Sections 143(2) and 143. This is where the tax department takes a deeper, more granular look at your return to ensure its correctness and completeness. It's initiated when the AO serves a notice under Section 143(2), asking you to present your case, documents, and explanations.
Is there a time limit for them to send that scrutiny notice? Can they just send it anytime?
No. Crucially, this notice under 143(2) cannot be served after 3 months from the end of the financial year in which the return was furnished.
Only 3 months. That's tight.
Yes, that's a very important deadline for the tax department. Following the notice, the AO proceeds to gather evidence, consider all material, and then makes an assessment order determining your income or loss and the tax payable.
What about special cases, like trusts?
There are special cases, for instance, for entities like charitable trusts. If a specified violation occurs, such as income being used for non-charitable purposes, the AO refers the matter to the principal chief commissioner or commissioner to withdraw approval or registration. The assessment order isn't finalized until effect is given to that higher authority's order, and the period of reference is excluded from the overall assessment time limit. And finally, we have the best judgment assessment under Section 144. This is when the AO essentially makes the call for you. It's the tax department's default judgment.
So if you don't engage, they'll make the call for you and it won't be in your favor.
Exactly. It's mandatory for the AO to make a best judgment assessment if the assessee completely fails to file return under 139.1 and does not file a belated return under 139.
Okay, failure to file at all.
It also kicks in if you fail to comply with a notice under 142.1 for
Yeah.
accounts or information, or a notice under 143 for scrutiny assessment, or if you fail to get your accounts audited or inventory valued as directed under 142.2a.
So failure to cooperate, basically.
Yes, generally you must be given an opportunity of being heard via a show cause notice before a best judgment assessment is made, ensuring fairness. However, this isn't required if a 142.1 notice was already issued and you didn't comply. The outcome is that EO assesses your total income or loss to the best of their judgment based on available information, and crucially, no refund can be granted under this section.
An important layer of oversight in the assessment process comes from the Joint Commissioner under Section 144A. How does their role influence the assessing officer's work? Can they tell the AO what to do?
Yes, under Section 144A, a Joint Commissioner has significant power to examine assessment records and issue binding directions to the assessing officer. This can be done on their own motion, suo motu, or if the AO refers a specific case to them, or even on an assessee's application. These directions are binding on the AO, providing a level of consistency and ensuring that complex or contentious issues are handled with a higher level of oversight and expertise.
Binding directions, but are there safeguards?
Absolutely. A crucial safeguard is that no directions prejudicial, meaning harmful to the assessee, can be issued without first giving the assessee an opportunity of being heard. Directions on the lines of investigation, however, are not considered prejudicial and don't require this hearing.
Okay, now Section 144B, faceless assessment. This is truly a massive paradigm shift in tax administration, aiming for unprecedented efficiency and transparency by removing physical interaction and leveraging advanced technology. Can you walk us through the spirit of how faceless assessment works rather than just the minute details? Think of it like a digital assembly line for tax cases.
That's an excellent way to put it. Faceless assessment, introduced effective from April 1st, 2021, is all about conducting assessment proceedings electronically via what's called the e-proceeding facility through your registered account on a designated tax portal. The core idea is to eliminate direct human contact and introduce automation and team-based assessments.
A digital assembly line.
Imagine your tax case entering this digital assembly line. Firstly, the National Faceless Assessment Center, or NFAC, which is the central orchestrator, selects your case for faceless assessment and intimates you. You'll receive a notice, say under Section 143, for scrutiny. All your responses, documents, and submissions happen digitally through the portal.
So you're not interacting with a specific officer, but a system. And your case goes to who?
Precisely. Your submissions go to the NFAC, which then forwards them to an anonymized assessment unit. This assessment unit is a team of tax officers working digitally, often located in different parts of the country. If the assessment unit needs more information or clarification, they'll request the NFAC to issue notices for documents from you or other persons. They might also request an inquiry or verification to be conducted by a separate verification unit, or technical assistance from a technical unit for specialized matters like transfer pricing or property valuation. All these units operate independently without knowing your identity or your location.
Different anonymous units handling different parts.
Yes, the entire process involves multiple digital handoffs. Your responses come back to the NFAC, which routes them to the assessment unit. If you fail to comply with any notices, the NFAC informs the assessment unit, which then prepares a notice under Section 144 for a best judgment assessment, again, served through the NFAC. After considering all responses and reports from other units, the assessment unit prepares a proposal for determining your income or loss. If there are any variations that would be prejudicial to you, meaning increasing your tax liability, they'll issue a show cause notice and you get another chance to respond.
It sounds incredibly thorough, but also very impersonal. Are there any provisions for an actual conversation if things get really complicated, or if you want to explain something personally? Can you request a hearing?
That's a critical consideration. While the default is faceless, there is a provision for a personal hearing via video conferencing if a prejudicial variation is proposed against you and you request it.
Ah, video conferencing is possible.
Yes. This ensures that no one is denied the opportunity to present their case verbally or clarify complex points due to the lack of physical interface. Ultimately, the assessment unit prepares a final proposal. Now, this might go to a review unit if there are complex issues or prejudicial variations before the assessment unit prepares the draft order. NFAC manages this flow.
Okay, so there's a review stage, too.
Potentially, yes. Finally, the NFAC directs the assessment unit to pass the final assessment order, initiates any penalties, and serves the order and demand notice electronically. This entire process, from start to finish, aims for unprecedented efficiency and transparency by leveraging advanced technology and removing physical interaction. But of course, like any complex system, the question always remains, what happens if the technology fails or if a nuance is missed in a purely digital interaction?
Right. Moving to another critical area. What happens when the tax department believes income has escaped assessment? This is the tax department's way of saying, we might have missed something, but we can always come back for it. This area has seen some significant overhauls recently, especially with search cases moving out.
You're right, sections 147 to 151 govern income escaping assessment, but there have been significant changes, particularly by the Finance Act 2021 and the Finance No. 2 Act 2024. As of September 1st, 2024, search and requisition cases are now covered under a new Chapter 40B dealing with block assessments and are excluded from the general income escaping assessment provisions. This simplifies the reassessment framework by creating a separate, dedicated process for search cases.
So under the general rule, Section 147, if income has escaped assessment for any year, the AO can reopen it. But can they just look at the specific issue that escaped, or do they get a wider scope once the case is open? Can they look at other things too?
That's a key point. Under Section 147, if the assessing officer has information suggesting that income chargeable to tax has escaped assessment, they may assess or reassess such income, or recompute loss or depreciation. And here's the wider scope. Once the proceedings are legitimately initiated based on that information, the AO can assess income on any other issue that escapes assessment and comes to their notice during the reassessment proceedings, even if the preliminary procedure under 148A wasn't specifically followed for that particular other issue.
So once the door is open, they can look around.
In essence, yes.
Yeah.
This gives them a broader mandate once a legitimate inquiry is opened.
Now, before issuing that reopening notice under 148, there's this Section 148A procedure, a kind of pre-notice step.
Yes. Before issuing a notice under Section 148 for income escaping assessment, Section 148A mandates a crucial preliminary step, acting as a safeguard for the assessee. If the AO has information suggesting that income has escaped assessment, they must first serve a show cause notice to the assessee.
A show cause notice first.
Exactly. This notice has to be accompanied by that supporting information, asking why a 148 notice for reassessment shouldn't be issued. This gives you a chance to explain or clarify before the formal reassessment process begins.
So it's a preemptive transparency measure. You get a chance to explain yourself first, and after you reply, the AO decides whether to proceed.
Precisely. The assessee then has a specified period to reply to this show cause notice. After considering your reply and all available material, the AO passes an order importantly with prior approval of a specified authority, which is typically an additional commissioner-director or joint commissioner-director determining whether it's actually a fit case to issue the 148 notice. This multi-step process with prior approval ensures that reassessment is not arbitrary.
But this 148A step isn't always needed. When can they skip it?
That's right. There are scenarios where this 148A procedure does not apply, meaning the AO can directly issue a 148 notice. This includes cases where the AO receives information under a scheme notified under Section 135A, which relates to the faceless collection of information. Our sources also specifically note that if information was collected under Sections 133, power to call for information, 133B, power to collect information by survey, or 133C, power to call for information from any person for verification of information in database, then Section 148A is not needed before issuing a 148 notice. These are situations where the information is often clear-cut or comes from verified sources.
Okay, so once the 148A procedure is complete, or if it's skipped, the AO issues the formal notice under Section 148. What happens then?
Once the 148A procedure is complete, or if it's not applicable, the AO then issues the formal notice under Section 148. This notice, along with a copy of the 148A order, if applicable, requires the assessee to furnish a return within 3 months from the end of the month in which the notice was issued.
3 months to file a new return.
Yes. If the return is filed within these 3 months, it's deemed to be a valid return under Section 139. If filed after, it loses that status.
And what kind of information triggers all this? How does the tax department decide which files to reopen? It can't just be a random guess, right? What counts as information?
You're right, a reassessment isn't arbitrary. It's triggered by specific types of information, which the tax department continuously gathers from various credible sources. This information for the AO can come from a risk management strategy formulated by the CBDT itself, perhaps based on data analytics. It could be an audit objection raised by internal or external auditors. It could also be information received under international agreements, like double taxation avoidance agreements.
National info.
Importantly, it includes information from the faceless collection scheme under 135A. It could also stem from information resulting from a tribunal or court order that points to escaped income.
Court orders, too.
And, newly added with effect from September 1st, 2024, information emanating from a survey conducted under Section 133A, other than surveys purely for verifying TDS and TCS, also serves as valid information to trigger reassessment. So these are specific, verifiable triggers moving away from subjective reason to believe and towards data-driven reasons for reopening assessments.
These precise time limits and thresholds are absolutely critical. A notice issued even a day late can be invalid, so understanding these specific windows for reassessment is paramount for both the tax department and for us, the taxpayers. What are the general rules for how long the tax department has to issue these notices under Section 149? How far back can they go?
For a 148 notice issued from September 1st, 2024, the general rule is that no notice can be issued after 3 years and 3 months from the end of the relevant assessment year.
3 years and 3 months, that's specific.
Yes. So for assessment year 2023-24, that would mean roughly by December 31st, 2027. However, this limit can extend significantly up to 5 years and 3 months from the end of the relevant assessment year.
Okay, longer window if.
If the AO has books, documents, or other evidence showing that the escaped income related to an asset, expenditure, transaction, or entries amounts to or is likely to amount to 50 lakhs or more.
50 lakhs or more escaped income allows them to go back further.
Exactly. This extended window is designed for cases of more significant underreporting.
And for the preliminary 148A notice, same timeline.
Slightly different. And for the 148A show cause notice, also from September 1st, 2024, the general limit is 3 years from the end of the relevant assessment year. But this can extend up to 5 years from the end of the relevant assessment year if the escaped income, based on the AO's information, is likely to be 50 lakhs or more. So there's that subtle but important difference. 3 years for 148A generally, but 3 years and 3 months for the 148 notice.
Let's consider that example again to make the 50 lakh threshold real. Mr. Sanskar had a massive 5 crore marriage expense in 2018. Under the rules applicable before September 1st, 2024, would the AO have been able to reopen his 2018-19 assessment, which is AY 2019-20, given that it's beyond the typical 3-year window?
Yes. Under the previous rules, because 5 crore rupees clearly exceeds the 50 lakh rupee threshold for escaped income, the AO could issue a 148 notice for AY 2019-20. The pre-2024 rules allowed for reassessment up to 10 years for such high-value escaped income based on evidence of assets or expenditures. This illustrates how that higher threshold triggers a significantly extended time limit for reassessment, specifically targeting larger instances of undeclared income or assets.
And these time limits can be paused sometimes.
Yes. It's also important to know that various periods are excluded from these time limits. For example, any time during which assessment proceedings are stayed by a court order, or the time taken for specific inquiries like a general anti-avoidance rule GAR reference, or a special audit period. These exclusions ensure that the tax department isn't penalized for delays caused by external factors.
Carrying on the theme of faceless administration, Section 151A empowers the central government to notify a scheme for the faceless assessment of income escaping assessment. So even the complex process of reopening old files is moving into the digital realm. No more dusty files.
Well, hopefully fewer dusty files. Precisely. This extends the principles of efficiency, transparency, and accountability by eliminating physical interface, optimizing resources, and introducing team-based approaches with dynamic jurisdiction to processes like assessment, reassessment, and recomputation under Section 147, and for the issuance of 148 and 148A notices and 151 sanctions. Notification 18-2022 confirmed this faceless process for 141-148 with automated allocation based on risk management strategy. This is the logical, ambitious extension of the broader move towards digital tax administration, ensuring consistency and impartiality even in these more contentious cases.
Beyond the main reassessment rules, Section 152 covers a couple of other important points, a bit like the fine print. What's in there?
Firstly, income that has escaped assessment is charged to tax at the rates that were applicable to the respective year in which that income was originally liable to be taxed.
Yeah.
This ensures the correct historical tax rates are applied.
Fair enough. Tax at the old rate.
Secondly, under Section 152(2), an assessee can claim that proceedings under Section 147 be dropped. This is a niche provision, applicable if you can prove you've already been assessed and paid tax on the income or transaction in question, and that the original assessment order for that income was not disputed through appeal or revision.
So it's a theoretical safeguard, but maybe not used very often. Our audio source seemed to think so.
That's the commentary's perspective, that it has little practical use because the conditions are quite specific, and often, if the AO has information, it implies the income wasn't already assessed correctly. Lastly, Section 152(4) clarifies a crucial transitional rule. If a 148 notice or 148A order was passed before September 1st, 2024, then the assessment is governed by Sections 147 and 151 as they stood before the Finance No. 2 Act 2024 amendments.
Okay.
This prevents a retroactive application of the newest rules.
Okay, good transitional point. Now, Section 153. This is where the rubber meets the road. Knowing these deadlines for completing assessments is crucial, both for the tax department and for us, the taxpayers. It's like a complex choreography of legal timelines that determines how long your financial affairs can remain under scrutiny. What's the general trend for these completion deadlines? Have they gotten shorter?
Indeed, Section 153 provides extensive time limits for the completion of various types of assessments and reassessments. The general trend for ordinary assessment orders under Section 143 or 144 has been towards shorter timelines to provide more certainty. For assessment year 2017-18 or earlier, it was 21 months from the end of the AY. This gradually reduced.
21 months, nearly 2 years back then.
Yes. It reduced to 18 months for AY 2018-19, then 12 months for AY 2019-20. It temporarily went back up to 18 months for AY 2020-21, likely due to the pandemic disruptions.
Right, COVID effect.
Then further reduced to 9 months for AY 2021-22. More recently, for AY 2022-23 and subsequent years, it's now set at 12 months from the end of the AY. The goal is definitely to finalize assessments within a reasonable period, generally a year now.
Okay, 12 months seems to be the standard now for regular assessments. And what about those updated returns we discussed, or reassessments where income has escaped? Do they have different timelines for completion?
Yes, they do. If an updated return under Section 139(8)(a) is furnished, the assessment order can be made at any time before the expiry of 12 months from the end of the financial year in which that updated return was furnished.
12 months from filing the updated return.
Correct. Similarly, for returns filed due to a CBDT order under 119B, the limit is also 12 months from the end of the financial year the return was furnished. For reassessments under Section 147, if the 148 notice was served before April 1st, 2019, the completion time was 9 months from the end of the financial year the notice was served. If the notice was served on or after April 1st, 2019, it's 12 months from the end of the financial year the notice was served.
12 months for reassessment, too, mostly now. What if an assessment gets set aside on appeal?
If an original assessment or order is set aside, canceled, and referred back to the AO by an appellate order from, say, the Commissioner, Appeals, or the Income Tax Appellate Tribunal, a fresh assessment must be completed within 9 months from the end of the financial year in which the order was received, if passed before April 1st, 2019, or 12 months if passed on or after April 1st, 2019.
12 months for fresh assessments, too.
And if an assessment or reassessment was pending on the date a search under 132 or a requisition under 132A was initiated, the period for completion is extended by 12 months. And if reference is made to the Transfer Pricing Officer, or TPO, during assessment proceedings, an additional 12 months is available for completion, recognizing the complexity of such valuations.
It sounds like there are many factors that can pause or extend these deadlines. What are some of the most common reasons a timeline might be excluded from the computation period? Court stays, audits.
You're right. There are numerous situations where specific periods are excluded from the overall time limits, ensuring fairness. For example, any time during which assessment proceedings are stayed by a court order or injunction is excluded. The period taken for a special audit under 142(2)(a), from direction up to report furnished, max 180 days, is also excluded, as is the time for evaluation officer reference. Other exclusions include the time for obtaining withdrawal of approval for certain institutions, or the time for referring a case to the approving panel under GAAR, or time taken for an advance ruling application, or even time for rehearing if the officer changes. This complex web of timelines ensures that assessments aren't open indefinitely, but also provides necessary flexibility for the tax department when faced with external delays or complex inquiries.
After all the assessment and reassessment is done, there's still a mechanism for correcting mistakes, a sort of post-assessment cleanup, and that's rectification under Section 154. It sounds like an important safety valve for both taxpayers and the tax department. How does it work?
Section 154 grants income tax authorities the power to rectify any mistake apparent from the record. This is a crucial provision for correcting clear errors without having to go through a full-blown reassessment, which is a much more involved process. What constitutes a mistake apparent from the record is key here. It can be a mistake of fact or even a mistake of law,
Okay, fact or law?
such as mistakenly treating non-agricultural income as agricultural income or a clear arithmetical error.
So it's not just any mistake. It has to be something really obvious, like a typo, right? Not something that requires a deep legal debate. Can't be just a change of mind.
Exactly. It must be a glaring, obvious, patent, or self-evident error. It cannot be something that requires a long-drawn process of reasoning or involves points where there might be two reasonable opinions. A mere change of opinion on a legal point by the assessing officer is not a valid basis for rectification. Think of it like a clear typo on a document or using the wrong formula in a spreadsheet. It's an error so obvious that anyone looking at the record would instantly spot it without needing to dig into deeper arguments.
But what if the law changes later? Or a big court case clarifies something?
Ah, that's a profound insight. A subsequent Supreme Court decision can, in fact, constitute an apparent error, allowing for rectification of past orders that contradict it. Similarly, if a law is amended retrospectively and an existing order is clearly inconsistent with that amended provision, it can also lead to rectification. This highlights the dynamic nature of legal interpretation and how it can trigger a need for corrections.
There's also this concept of the doctrine of partial merger related to appeals. How does that affect rectification? If something went to appeal, can the AO still rectify other parts?
That's a crucial point. If a matter was decided on appeal, the original authority's order merges with the appellate order only on the points decided in appeal. This means the original authority can still amend their order on other matters that were not considered and decided in that appeal using Section 154.
Okay, so only the appealed points are merged. How is rectification started?
Rectification can be initiated suo motu by the authority itself, or it can be brought to their notice by the assessee, deductor, or collector. If the amendment would enhance the assessment, reduce a refund, or increase your liability, an opportunity of being heard must be given to you, ensuring fairness.
Hearing required if it harms you.
Yes. If the amendment reduces liability or results in a refund, a written order is passed and the refund is made. If liability increases, a notice of demand is served. The time limit for rectification is generally 4 years from the end of the financial year in which the order sought to be amended was passed.
4 years.
If an application for amendment is made by you, the authority must pass an order within 6 months from the end of the month the application was received, but still within that 4-year general limit.
And that CIT v. Electronics Limited case confirmed the merger doctrine affects this timeline, right? The 4 years runs from the appellate order if the point was appealed.
Precisely. If an appeal on a point is decided, the AO's order merges with the appellate order on that point, and the 4-year limit for rectification on that point runs from the appellate order, not the original assessment order. So, yes, there's a safety net, but you have to use the right process.
Got it. Beyond the general rectification under 154, Section 155 allows for specific amendments to assessment orders due to certain defined events. These are like special cases.
Exactly. These provisions often override the general limitations of Section 154, and their time limit is frequently different, often 4 years from the event itself that triggers the amendment, rather than the original order date.
So these are special cases that ensure tax consequences align with real-world events or legal finality, even years later. Can you give us a few examples of these specific amendment triggers? What kind of events?
Yes, they cover a wide range of specific circumstances, ensuring accuracy even after initial assessment. Examples include situations where capital gains reinvestment under Section 54 series wasn't fully done, but the time limit expires later, or where certain deductions, like those for export turnover under ADHHC, were subject to specific conditions that might change later,
Okay.
or where a firm's remuneration was disallowed, subsequently affecting a partner's assessment. Another common one is if an association of persons, AOP, or body of individuals, BOI income variation, affects a member's assessment, or if an excess loss or depreciation was disallowed in reassessment under 147, impacting subsequent years. Even if capital gains become chargeable under Section 47A due to certain transfers or if dividend income was taxed in the wrong year, amendments can be made.
What about foreign tax credits or TDS issues?
Yeah.
There are newer rules, too, like Rule 132 from 2024, which allows an assessee to apply for recomputation of total income if credit for foreign tax was not allowed earlier, due to the foreign tax being in dispute, but it later gets settled. The AO will then amend the order to allow the credit. Also, a very practical amendment under Section 155.14 allows the AO to amend in order to allow TDS or TCS credit if the certificates weren't furnished with the original return but are produced within 2 years from the end of the assessment year. These provisions ensure that the tax position accurately reflects subsequent events.
Okay. Once all the reassessment rectification is done, the tax department communicates the final outcome formally through a notice of demand under Section 156. This is when you know what you owe or if you're getting a refund.
Yes. Whenever any tax, interest, penalty, fine, or other sum is payable under the Income Tax Act, the assessing officer serves a notice of demand in the prescribed form, clearly specifying the sum payable. Interestingly, intimations issued under 143.3.1 for summary assessments, or those issued for TDS statements under 200A, or TCS statements under 206CB, are all deemed to be notices of demand. So, you might receive what looks like an intimation, but it carries the full legal weight of a demand notice.
I understand there's also a special rule for tax on perquisites from ESOPs or sweat equity shares, especially for startups. It's taxed in the year of exercise, but the payment date is deferred, right? How does that work?
That's a crucial deferral designed to support startup employees. While the perquisite from employee stock ownership plans or sweat equity shares is taxable in the year of exercise, the actual payment due date for the tax is deferred. It becomes payable within 14 days from the earliest of 3 events, 48 months from the end of the relevant assessment year, 4 years later, or the date you sell those shares, or the date you cease your employment, whichever comes first. This provides much-needed liquidity relief for employees of eligible startups who might otherwise face a significant tax bill before they can monetize their stock options.
Okay. What if a demand notice needs changing because of, say, an insolvency case? Section 156A.
Right. If a demand for which a notice has been issued under Section 156 is later reduced as a result of an order by an adjudicating authority under the Insolvency and Bankruptcy Code, the AO must then modify that demand to conform with that order and serve a revised notice of demand. This new notice is then deemed to be a Section 156 notice. Furthermore, if that adjudicating authority's order is itself modified by the National Company Law Appellate Tribunal, NCLAT, or the Supreme Court, the demand notice is revised accordingly. This ensures that tax demands align with the final legal outcomes of insolvency proceedings.
It's not always about collecting tax. Sometimes it's about acknowledging a loss you can carry forward. Section 157, Intimation of Loss. This seems like a critical piece of information for taxpayers. The AO tells you how much loss you can carry forward.
Absolutely. When an assessee establishes a loss that they are legally entitled to carry forward and set off against future income, such as business loss, speculation business loss, capital gains loss, or loss from owning and maintaining racehorses, Section 157 mandates that the assessing officer must notify the assessee in writing of the computed loss amount. This is vital for your future tax planning.
That's a fantastic point. It shows that the tax department isn't just there to collect. They also have a duty to help you claim legitimate reliefs, even if you might have overlooked something yourself. The audio source mentioned some cases about this, about the AO having to allow set-off.
Exactly. This point is backed by strong legal precedent. CBDT's Circular Number 14 of 1955 and the CITV Mahalakshmi Sugar Mills Co., Ltd., 1986, case clearly confirmed that the AO must allow the set-off of carried forward losses, like business loss under Section 72, even if the assessee didn't explicitly claim it in their return, provided the loss was determined as per 139.3. The crucial word shall in Section 72 makes it a mandatory obligation for the AO. It highlights the tax authority's duty to assist taxpayers in claiming legitimate reliefs, ensuring that the system is not solely focused on collection, but also on accurate and fair application of the law.
Carrying on the theme of faceless administration, Section 157A empowers the central government to notify a scheme for faceless rectification, amendments, and the issuance of notices or intimations. So this digital transformation is really comprehensive, touching almost every part of the assessment journey, even the final notices.
Indeed. This extends the principles of efficiency, transparency, and accountability by eliminating physical interface, optimizing resources, and introducing team-based approaches with dynamic jurisdiction to post-assessment processes like rectification of mistakes under 154, other amendments under 155, issuance of demand notices under 156, and intimation of loss under 157. This is the logical extension of the broader move towards digital tax administration, ensuring consistency and speed across the entire tax lifecycle.
Okay, finally, let's talk about the big one. Block assessment for search cases under the new Chapter 4B, effective from September 1st, 2024. This is a massive change, a complete overhaul for search cases, aiming for a streamlined, self-contained assessment process for undisclosed income over a specific block period. It's clearly a significant move by the government to crack down on unaccounted wealth and make these investigations more efficient.
You're right. Chapter 4B introduces a new, simplified regime specifically for search and requisition cases, moving them away from the general 147-151 provisions. The primary goal is indeed earlier finalization of search assessments and a reduction in the multiplicity of proceedings that often arose in the past. Key terms here include the block period.
What's the block period exactly?
It's a specific time frame for assessment. It comprises the previous years relevant to the 6 assessment years immediately preceding the search or requisition, plus the period from April 1st of the search year up to the actual date of the search.
6 prior years plus the current year up to the search date.
Okay, and undisclosed income in this context sounds like it's defined very broadly. What does it cover?
It is. Undisclosed income is broadly defined to include any money, bullion, jewelry, or valuable article, any expenditure or any income based on entries in books, documents, or transactions that are not recorded in the books, are partly recorded, or are simply not disclosed to the tax authorities. It captures various forms of black money.
And old pending cases get wiped out. The crucial practical effect is the abatement of pending proceedings under Section 158BA5. This means that most pending assessments or reassessments for the block period effectively get wiped clean or merged into this new consolidated block assessment. It's like pressing a reset button on those old files for the specific block period.
But regular income is still assessed separately.
Yes. It's important to note that total income other than undisclosed income for the search year is assessed separately under other provisions of the Act. The tax on undisclosed income discovered during the search is charged at specific rates within Chapter 4TB, and importantly, previous year losses or unabsorbed depreciation cannot be set off against this undisclosed income. This is a deliberate design choice to ensure that undisclosed income is taxed without offsets.
So the procedure under Section 158BC is also very specific for these block assessments, right? It's not like a regular assessment at all. How does it work?
That's right. The AO issues a notice, with prior approval of a senior officer, ADL.CD or JTCD, to the SSC within 30 days of the search or requisition, requiring them to furnish a return for this defined block period within 3 months.
3 months for a block return.
Yes. The AO then determines the total income, including all the undisclosed income, applying relevant provisions for assessment like 142, 143, 143, etc. A key point. The Dispute Resolution Panel, DRP provisions under Section 144C do not apply to block assessment orders.
No DRP route for block assessments.
Correct, meaning there's no DRP route for these. Returns filed under this chapter are also not subject to 143 automated processing, nor can they be revised. And no Section 148 notice is required to initiate this. The search itself is the trigger.
What if they find income belonging to someone else during the search?
If undisclosed income of another person is found during a search, their AO is handed the records and proceeds under this same section, 158BD.
Okay. What's the deadline for completing these block assessments? Given the complexity of search cases, I imagine it's quite generous.
The time limit for completing a block assessment under Section 158BE is typically 12 months from the end of the month in which the last authorization for search or requisition was executed. Various periods are excluded from this limit, such as court stays, special audit periods, TPO references, or GAAR references, to ensure the tax department has sufficient time to complete the complex investigation.
12 months. And the consequences for not complying? Penalties.
And finally, the consequences of non-compliance with these block assessment procedures under 158BEE are severe. Interest for delay in filing the block return is 1.5% per month on the tax on undisclosed income. There's also a significant penalty for undisclosed income, which is 50% of the tax leviable on it.
50% penalty. Steep.
However, immunity from this penalty is granted if the undisclosed income is declared and the full tax, interest, and penalty are paid before the search or requisition even takes place. The assessment for the block period must be passed by an AO, not below the rank of Deputy or Assistant Commissioner Director, with the prior approval of an additional or Joint Commissioner Director, reflecting the gravity of these cases.
And that wraps up our deep dive into the intricate world of income tax assessment procedures. Phew! From the nuances of filing your return and the crucial role of PAN and Aadhaar, to the depths of special audits, the groundbreaking faceless assessments, and the revamped rules for income escaping assessment and these new block assessments for search cases, we've covered a vast and vital landscape.
We certainly have. We've seen how precision and compliance is paramount, how technology is rapidly transforming tax administration to be more efficient and transparent, and how the law continually adapts to ensure both fairness and more effective revenue collection. Understanding these procedures isn't just for tax professionals, it's truly essential for anyone navigating the financial world, as these rules impact everyone from individuals to multinational corporations.
Absolutely. It's clear that while the tax system is complex, it's also built on a foundation of specific rules and increasingly on digital interactions and data-driven insights. It's a system constantly evolving, that's for sure.
Constantly evolving.
So, for our learners out there thinking about everything we've discussed, what aspect of these assessment procedures stands out to you as the most impactful for a taxpayer? Perhaps the shift to tracking economic footprint over just income, or maybe the implications of faceless assessment.
Good questions to ponder.
And on the flip side, what might be the biggest challenge for the tax authorities in implementing these increasingly faceless and automated processes, especially when human nuance or complex explanations might be needed? Keep those questions churning and join us next time for another deep dive.